Hi, my name is Enmal Sinha, and I'm here today with my colleagues Tiffany Wilding and Jerome Schneider. And we're here today to talk about the December Fed meeting, implications of that meeting, and where we see opportunities today. Tiffany and Jerome, thank you for being here today.
Thank you.
Tiffany, maybe we'll start with you. So as we expected and the markets expected, Fed raised rates for the fourth time this year, which now marks the ninth time in this cycle. What did you think were the key takeaways in terms of the statement, the press conference, and the so-called dot plot?
Yeah, well, I guess starting off, I think more broadly, the recent tightening in financial conditions that we've seen, some more indicators that global growth is slowing, I think just more broadly reduced or weakened the argument that the Fed needs to take monetary policy into restrictive territory this cycle. And when I say restrictive territory, they feel like they need to hike interest rates above where they see as kind of neutral. So I think that theme definitely came out in today's statement and a summary of economic projections. But I think at the same time, it's important to sort of caveat that despite downgrades to the forecast that we saw today, that the economic outlook is still above trend, and the U.S. growth is still expected to be above trend. The unemployment rate is expected to continue to fall, only modestly. But in that kind of environment, you still need to be hiking interest rates, especially when you are slightly below where you kind of think neutral is. So today's rate hike, as you suggested, brought the Fed funds rate, the effective Fed funds rate, slightly below kind of where they see those neutral ranges are. So we continue to expect them to hike into neutral territory in 2019, despite the fact that we've seen tighter financial conditions over the last several months.
Great, and it's interesting that you talk about growth still continuing, right? Because it seems like there's a little bit more of a negative tone in markets. So maybe, Jerome, we can turn to markets for a second. Interesting reaction today. How would you characterize the market response?
Well, it's punctuated by uncertainty given by the marketplace and then volatility that followed. When we initially had the announcement, basically we had a slight relief from a credit point of view and a risk point of view. But then as Powell came on stage and really started answering questions, the equity market sold off. The curve continued to flatten in the U.S. Treasury market. And the risk-off sentiments that we've seen sort of evolving over the past few weeks have really come together and become more profound. And so right now, the market's effectively priced out a lot of the rate hiking sequences that not only the Fed had forecasted, but we here at PIMCO had forecasted into 2019 and beyond. And now, from that point of view, we have to really think about, from a market point of view, if that's going to be happening, if there's really on the verge of a potentially recessionary environment, and that brings its own implications as well. But right now, where we stand, the implications are rather negative for the marketplace. That being said, what was given, clearly as Tiffany alluded to, was a more upbeat, data-dependent type of scenario analysis by Powell. And that data dependency is something that the market has become increasingly unsettled with, and it's again punctuated by a flattening yield curve.
So certainly a lot of discussion and debate about the future path of rate hikes. How many times will the Fed be hiking in 2019? So maybe, Tiffany, we can come back to you. What did you glean today about the path of rate hikes in 2019 and beyond?
Yeah, so I think first of all, one of the things that we've been talking about for a little while now is that as rates go into more neutral territory, the path of interest rates just naturally becomes more uncertain because you can either hike interest rates, you can stay on hold, or you could even cut. So we are getting into that area of neutral policy, and I think we saw FOMC participants, the range being that we could hike maybe 1, 2, or 3 more times in 2019. We at PIMCO believe that 1 to 2 more times is more likely, given our outlook, which is for a below consensus real GDP forecast. The factors that are behind that, in our view, are the fact that we have seen tighter financial conditions more recently, and slowing global growth, as well as fiscal stimulus, which should be fading next year.
So sentiment clearly has become a little bit negative, though, coming into this last year. Fourth quarter, fair to say, probably the biggest characterization of it is volatility. Pretty stark difference from Q3, where we had about an 8% equity market return in the quarter. Now we're looking at a year which is likely going to be a negative return year for the S&P, first time since 2008, really.
Right.
So when we think about that and the backdrop being one where uncertainty is rising, valuations still probably elevated, and volatility rising in those markets, how should investors be thinking about opportunities in 2019?
As we entered Q4, our analysis was basically that everything was going to be sinking lower in terms of global growth, U.S. growth, et cetera. That doesn't mean negative growth. That means still just simply positive growth in that 2 to 2.5% realm for the United States. And that's something that the Fed is going to continue to have to push back against in terms of normalizing their monetary policy. And that's what they concluded today. For investors, what it ultimately means is reacting to tighter financial conditions, slightly tighter liquidity conditions, both in nominal terms and relative terms. And that means risk assets are going to effectively reprice. But investors are going to have to be prudent in allocating risk into several different ways. One, thinking about the trajectory of rates. Ultimately, what does that risk-free rate mean to risk assets as it moves higher? Secondly, the cost of liquidity clearly going higher. So investors are going to have to be focused on the liquidity aspects of being defensive when they need to be, but also the liquidity aspects of the risk assets they're making. And then finally, be more selective in actual risk. So from a fixed income portfolio analysis, still be prudent in terms of the beta allocations you're taking. There's plenty of opportunities to be more defensive. Look to the front end of the credit curve, where you can find good yields in the realm of 2.5% to 3.5% or more in 1 to 2 year type of corporate credits if you truly want to de-risk. And then finally, there's high quality situations, including agency mortgages and mortgage-backed securities, which offer you not only the security of an asset, but really coming forth and looking in to having good quality spread along the way.
Great. Thank you, Tiffany. Thank you, Jerome, for being here. And I look forward to continuing the conversation in the new year, which may be a little bit more frequent given that the Fed press conferences will also be more frequent. And thank you all for joining us today.